basically the fiscal situation is in fact worse this year than what it shows up.
Every Fed tightening cycle of the last 40 years has claimed a major financial casualty.
So we can fix half of the inflation problem just through supply chain healing.
We really do expect an unprecedented modern era hiking cycle from the Fed.
Good morning, everyone. Welcome to the latest installment of our Economic Advisory Council series. I'm Garrett Hawkins, Communications Director at the Institute of International Bankers, or IIB. As you may know, the Economic Advisory Council is a partnership between the IIB and our friends at the Global Business Alliance. It's designed to highlight and share the expertise of our member institutions, which are all internationally headquartered firms operating and investing in the United States. Concerning the IIB's membership, we represent internationally headquartered financial institutions from more than 35 countries that operate in the United States. Our mission is to ensure that U.S. banking laws and regulations are applied fairly so our member institutions can compete on a level playing field with domestic institutions. This is critically important because our members inject billions of dollars each year into state and local economies across the country through direct employment, capital expenditures, and other investments. Along with GBA, we're fortunate to have a vast knowledge and expertise within our memberships. And we want to share that with you, the folks shaping policy conversations in Washington and around the country, so that you can benefit as well. I hope you find today's session as beneficial as I know I will. Now, I'd like to turn the virtual floor over to Nancy McLaren, President and CEO of the Global Business Alliance.
Thanks so much, Garrett, and good morning, everyone. Yes, we at GBA have really enjoyed partnering with the IIB to bring to you the Economic Advisory Council, which brings top economists from our member companies. I think most of you are familiar with us, but for those who are not, the Global Business Alliance is a trade association based in Washington, D.C. We have about nearly 200 member companies. All of our companies are major U.S. employers. Across the United States, our members employ about 8 million people in every corner of the economy. Our members come from 22 different countries, all friends and allies of the United States. And the main mission of our organization is to ensure that the United States stays globally competitive for investment and job creation. And right now, the U.S. is the top location for foreign direct investment. So with that, I'd like to go ahead and introduce our speaker for our final EAC installment for 2023. Dan North is Senior Economist at Allianz Trade North America. Allianz Trade North America is a global leader in trade credit, insurance, and a recognized specialist in the areas of surety, fraud insurance, structured trade credit, and political risk, among other offerings. Dan has been with Allianz since 1996, using macroeconomic analysis to help manage the company's risk portfolio of more than $150 billion in annual U.S. trade transactions. He's appeared on CNBC, Fox Business News, and Bloomberg Radio and television. He's been quoted in a variety of top-tier publications, including Business Week, the Financial Times, the New York Times, and the Wall Street Journal. After having predicted the 2008-2009 recession and its implications accurately, he was ranked 4th on Bloomberg's list of top 65 forecasters in 2010. Dan holds an MBA from the Wharton School of Business, and today Dan is going to lead us through his expert analysis as we round out 23 and head into 2024. We'll conclude with a Q&A session. So if you'd like to ask Dan a question, simply submit it in the chat box. And so with that, Dan, I'd like to turn it over to you. I'm really looking forward to hearing your thoughts.
Well, yeah, thank you very much for that kind introduction, Nancy. And I certainly appreciate everybody from GBA being here and the invitation to speak. As Nancy mentioned, Allianz Trade is the world's largest provider of trade credit insurance. And I think one of our folks is going to bring up the slides, or is that up to me from this side? There we go. Okay. So Allianz Trade, the world's largest provider of trade credit insurance. And basically the way it works is our clients sell goods and services to other businesses on open account and hope to get paid back in 30 or 60 or 90 days. But they run the risk that that business they sold to will run into financial trouble and be unable to pay them back. We protect our clients against that. We protect them against non-payment. We've been around for over 100 years. We're in 52 countries around the world, starting up in the upper left. 5,500 employees, 62,000 clients. We're AA rated and so forth. Lots of other numbers, but my favorite one is the one all the way down in the lower left, 1,000 claims indemnified each week. Trade credit insurance is a discretionary purchase. It's not like auto insurance that you have to buy to drive. It's discretionary. So we have to show our clients value. And the way we do that is by paying claims. Every CEO that's ever come into this and our North American business has said we've got to pay more claims because, that's counterintuitive for an insurance company, but that's how we add value for our clients. And we pay a lot of claims. So you can see that we really want to be tuned into the sensitivity of the likelihood of companies going bankrupt. And I was very interested in the video that played at first because, first of all, they all agreed with what I'm saying. But most importantly, one of them was saying that the Fed Reserve, every time the Fed Reserve goes into a hiking cycle, it always ends in some sort of big financial problem. And we are seeing that already. And another way to put it is the Fed keeps hiking until something breaks. And we are seeing that because we're seeing an enormous increase in bankruptcies. And as a result, an enormous increase in claims. Something like 50% increase year over year. Now, it's off a lower base, but it's still a very big increase. And that's where the Fed has broken things for us. Now, I'm going to speak for about 25 minutes. I'm going to start off with the positives in the economy because there are some, but then I'm going to take a little bit longer time to look at the negatives because there are even more of those. Now, the first positive is a big one across the top. Consumers. Consumers account for 70% of all economic activity, and they're still spending. That's the chart over on the left. Personal consumption expenditures. The columns are the month-to-month changes, so you can get an idea of what's happening most recently. And the black line is the year-over-year rate. So it gives you a bit longer trend, and it's running at 2.4%, which is okay. It's a little bit underneath the historical average, but that's what's has been driving the economy. To drive consumption, you need money. And that's the chart on the right. Income, real disposable personal income. That's after taxes and inflation. And you can see over the past few months, it actually was revised this morning, but the point of the chart is it's still pretty weak month to month and is driving that year over year rate down pretty sharply. It's still not really bad, but it, as you can see, is definitely declining. So consumers are still consuming, and they still have some power to do so with income, and we'll talk about that a little bit more later. But let's walk away from this saying, consumers are spending money. Two other things that are really working for us are the resilient labor market and the services sector. Now, the chart on the left is the labor market. There's a lot going on in this chart, but bear with me for a minute. It shows what I call the two big headline numbers. This comes out of the government's employment report, which comes out at 8:30 in the morning on the first Friday of every month. It's by far the most carefully watched economic release in the world. And the two big numbers are that black line, the unemployment rate, which until recently has been hovering around 3.4%, but has recently gone up pretty sharply to 3.9%. That's still fairly low, but it's a big move in a short period of time. And it's important also to understand what that unemployment rate means. You see, when the government makes this calculation, they count people as unemployed if they don't have a job but are looking for one. If you don't have a job and you're not looking for one, you're not counted as unemployed, you're counted as not participating. So that unemployment rate there doesn't take into account, approximately 40% or so of the population that is sitting at home. Doesn't take that into account. So it's important to know what it is. It's, a number that's carefully watched, but it only takes into account people that are either employed or looking for a job. The blue columns are the number of jobs created every month. And you can see that spike down there. That's the big loss we had in March and April of 2020. Well, that actually lost 22 million jobs. And since then, to the right, all those blue columns, we've been recovering jobs at the rate of about 400,000 a month. That's that red line. And that compares to previously, it was about 200,000 a month. So it's been pretty strong job recovery. But note the word I use, recovery, not growth necessarily. You see all those blue columns, only about 20% of those are newly created jobs. And here's what I mean. During the national shutdown, let's say you worked for a company that closed its doors for a month. Well, that was counted as a job loss. And then the next month, you suppose you went back to work, that was counted as a job gain. The job was never gone. It's just the door was closed for a month because of COVID. So all those jobs there really weren't created. They were just recovered from that shutdown. But let's walk away from this chart saying we have an economy that recovered lots of jobs and still a low unemployment rate. The other thing that's really working for us is the chart on the right, which talks about the services sector, and that's 80% of the economy. And this chart is from what we call the ISM survey, Institute of Supply Management. It's something economists like to look at, and the way you read it is if it's above 50, it means it's an expansion. So over there, the pale blue line, the total index at 45.5 basically means all of the services sector is expanding. This chart, this survey has 10 components. The dark blue one is one that's called new orders. These are orders coming into the pipeline that will create economic activity and employment going forward, very strongly above 50. So service is pretty good. So we've got consumers that are spending, we've got a strong labor market, we've got a strong services sector. Those are really good things. But there are problems as well. First of all, we have Washington and the budget and inflation and the Fed's cure and how it's damaging the economy and the housing market, manufacturing, freight, and the labor market. Now, let's talk about inflation. Actually, let's talk about the budget first. This seems to be like a previous version of the presentation I made, but this is a good point. Washington, the budget, there's been a lot of talk and a lot of hoo-ha about cutting the budget and so forth. And I would suggest that they're all arguing about the wrong thing. What I mean is over on the chart are on the left are federal budget outlays for 2022 as a percent of total. Well, you can see Social Security is 19%, health is 25%, that's Medicare and Medicaid, income security, a few other items. You see that red circle? That says 65% of the budget is mandatory spending. It's on autopilot. It doesn't get touched unless there's a big reform package. That's where 65% of the budget is. You can't touch it politically. Now, the chart on the right is the same thing, the same thing, but that shaded area shows the size of the deficit. So what the chart shows is if you can't touch those mandatory programs, you're going to have to wipe out most of the Defense Department and all the discretionary spending as well. And obviously, that's never going to happen. So that's the thing that really needs to be thought about, but it's just too politically dangerous This chart shows a snapshot in time. The chart on the right shows the budget over time, and you can see it greatly increased due to COVID spending, and that's not coming down. And because mandatory spending is going to continue to keep growing, our debt to GDP ratio, our debt is going to keep piling up. After World War II, it was somewhere around 35%. That's that dotted line. Well, now it will be up to over 100%. And so that's the thing that we're fighting in Washington. We're fighting about the wrong thing. It's great to whittle away at the parts you can whittle away, but it's not the big fight. Now, let's talk about inflation. The chart on the left shows inflation, the cause of inflation, really. It's mostly the Federal Reserve and Congress. Now, that chart on the left shows Fed policy. The Fed has two tools to manage inflation. One is that black line, which is the Fed funds overnight interest rate. You know, people say the Fed is raising rates, and that's, I say it too because it's very convenient, but really the Fed only controls one interest rate. That's that overnight Fed funds rate. If you go back in the 80s, you can see it was up as high as 20%. And then during the Great Recession, it was set down to 0 for emergency conditions, never been done before. And then it was raised back up and then set back down to 0 again when COVID came along. Emergency conditions. Now, the other tool the Fed uses is that blue area called the balance sheet. It's just the amount of money that the Fed makes available to the financial system to keep liquidity flowing, credit, loans, all the way down to individuals. Now, if you look all the way off to the left from 1973 till the early 2000s, that balance sheet really just didn't grow. It grew along with the size of the Federal Reserve and the economy until we reached the Great Recession. And then the Fed said, hey, let's use this as a tool. What we'll do is we're going to expand the balance sheet, make sure everybody knows there's plenty of money out there. It's also virtual money printing. That's there in that blue text. It's money printing. So this is the perfect formula for inflation. Too much easy money for too long. If you wanted to create inflation, that's what you'd do. You'd print money and set rates to 0. Now, as I say in the box in the middle, the Fed made several big mistakes. They put these emergency conditions in place in 2020, and then they kept them there for probably a year too long. Too much easy money for too long. Then they kept saying it's transitory, inflation's intransitory, and it wasn't. And then after they admitted it wasn't, they waited 4 more months to do anything about it. This is kind of hard for me to understand. Your house just caught on fire and you wait 4 months to dial 911. That's what happened there. So by the time they started to raise interest rates to fight off inflation, they were way behind the curve. And in that middle box, in number 3, important part is changes in monetary policy take 3 to 5 quarters to have full effect. So by the time they started, they were way, way behind. And number 4, it's important to note when a central bank raises rates to slow inflation, it's deliberately trying to slow the economy, and it works. That's the risk. Over on the right is fiscal policy. And I would argue that there was probably too much stimulus, too much easy money for too long. So that contributed, but it was really the Federal Reserve, I think, with their too much easy money for too long, which created the inflation. So let's take a look at inflation. The chart over on the left is the Consumer Price Index, kind of the headline number everybody looks at, and it was peaked at 9.1% back in June of 2022, and now it's down to 3.2%, and that's good. That's good. That black line going down from 9.1 to 3.2 doesn't mean prices are going down. It means that prices are still rising at the rate of 3.2% year over year. That's just slower than it was before. Prices are still going up. And I'll skip ahead to the next part. It's the problem with inflation is it's cumulative. That's the chart on the left. So if we go back to January of 2021, we see that wages, that black line, have risen 14%, and the things you need to live, like food, are up 20%, housing 29%, twice wages, and gasoline 3 times wages at 45%. It's the cumulative nature, and that's why you still get sticker shock going shopping. Prices are, and you think, wow, this seems like it's a lot more than it was, and they are. And they are. So the Fed sees this problem, inflation roaring out of control, wages falling behind, so they've had to go on the most aggressive hiking cycle in the modern era. That's the chart on the right. Each of those lines is the beginning of a Fed hiking cycle starting at month 0. And you don't have to look at all the lines, and when they started, all you have to do is look at the red line, which is where we are now, and you can see that the Fed has been the most aggressive in the modern era. Now the question is, has the Fed become too aggressive? And I would say that that is probably the case. Now I have this chart over there on the left, which is sort of conceptual. And again, the point is, it takes 3 to 5 quarters for monetary policy to have full effect. So each of those red lines is an interest rate hike. So at the bottom, the first one is March of 2022. You can see that arrow is kind of shot all the way through inflation and the economy. And the point is that interest rate hike has done everything it's going to do. May 2022, yeah, it's gone all the way through. June, July, September, November, if we're talking 3 to 5 quarters, well, it's probably gone most of the way through. December, January, March, May, July, those haven't had a chance to take full effect yet. There's that lag, which is so important. And we're going to look at how these increases have already affected things like over on the right, housing, manufacturing, labor market, and so forth. So let's start off by looking at the housing market, the first real victim of the Federal Reserve's increase. And that chart on the left, that vertical line is when the Federal Reserve basically said inflation is not transitory, we're about to raise interest rates. And that black line is the 30-year mortgage rate. It immediately launched from 3% and now is over 7%. And over that same time period, existing home sales have fallen 33%. Same thing, chart in the middle. Fed says we're going to raise rates. Starts and permits are down dramatically, but prices are still high. Mortgages are high. Prices are still high. You combine those things together, you get the chart on the right, which is the affordability index. And the lower it goes, the less affordable housing is. And it's around a 37-year low now. Another way of another sector that's been affected so dramatically is manufacturing. So the chart on the left shows 2 different measures of manufacturing. That black line is durable goods orders. That's actually, this is a month old. It's actually down to 0 now. And these are orders for things that are supposed to last more than 3 years. Big ticket items for which you usually need to borrow to buy, such as big appliances, aircraft, cars, that sort of thing. And you can see it's dropping off pretty dramatically. Now, the blue line is industrial production. It's just a measure of everything that's coming out of factory doors. And you can see that's now growing at a negative rate year over year. Now, chart on the right is this ISM survey for manufacturing now. And you can see it's below 50 at 46.7. That means we're in contraction. And that critical new orders component in contraction, meaning there's less stuff coming in the pipeline. So I think you can argue pretty clearly that manufacturing has suffered as well. How about the freight market? Freight's very important because everything you're looking at right now probably came to you by truck. And that's the chart on the left. Trucking expenditures down dramatically. The middle chart is rail. The chart on the right is shipping. So freight is in recession. Next thing where we're starting to see the effect is the labor market. Now, I started off early on by saying the labor market is in good shape, and it's true on the headline, those 2 big headline numbers, the unemployment rate and the number of jobs grown. But here's some other measures. The chart on the left is the rate of job growth. And you can see that's fallen pretty precipitously since February of 22. This is typically what you see as a slowdown comes. Over on the right, another measure of the labor market, average hours people are working. You can see how dramatically that's fallen off. Basically suggests employers have a little less work than they used to have for their employees. Here are a couple of other measures. The chart on the left, that blue line is initial jobless claims. And basically what this is let's say the company you work for went out of business, or the building burned down, or you just plain got fired. You go into the unemployment office and say, I need my unemployment benefits. That's the blue line, the number of people that are doing that every week. Now, when times are good, that blue line is falling. There are fewer and fewer people making claims for unemployment. But when times are bad, when that line bottoms out and starts going up, it means more and more people are filing for unemployment claims. And you can see every time it bottoms out, it's followed by a gray column, which is a recession. It's going all the way back to 1969. And we just bottomed out in last September as well. It's a pretty strong indicator. So I have some arguments I think are, under the surface, that there's weakness in the labor market. There's weakness in the economy in general, but I still get pushback here. People say, hey, last month we created 150,000 jobs. What are you talking about, a slowdown? How can we do that? How can we create jobs when there's a slowdown coming? And the answer is, that's the way it works. Labor is the last pillar of the economy to fall because people don't really want to lay people off unless they have to. And that's what the chart on the left shows. On the right, each of those lines is a different recession. And each of those lines starts 12 months before the recession, goes the vertical dotted line, which is when the recession starts, and goes out another 12 months. And they're plotted on the left against the number of jobs created. And the point of the chart is, in that green box, from 12 months before the recession, all the way until the recession starts, jobs, the economy is still creating jobs right up to the minute that the recession starts. And that's when you get the job losses. So the fact that you had a good report last month tells you nothing about what's going to happen next month. The labor market collapses in an instant. It's the thing that falls the least, falls the last. So I've showed you a couple leading indicators, one there on the left and a couple others, and there's some more coming. Here's one of my favorite ones. This is a leading indicator on the left called the Treasury yield curve. And really, it's just the difference between long-term and short-term rates. It's the difference between the 10-year and the 3-month interest rate. That's the blue line. So if we look over on the left and say that blue line is at 200 basis points, that might be where the 10-year is at 3% and the 3-month is 1%, and that gap is the 200 basis points. And you can see that gap is positive most of the time, because long-term rates are almost always higher than short-term rates, because if you're going to lend money for 10 years, you'll, demand a higher interest rate than for 3 months. Almost always, except times like now, when the Federal Reserve is raising short-term interest rates, and that relation of higher long-term rates and lower short ones reverses. And that blue line goes negative. And every time it does, it's followed by a recession 3 to 5 quarters later. And you can see we just bottomed out from a record low. Another leading indicator there on the right. So the chart on the left is the financial markets, the bond market, running the interest rate, saying to the Fed, hey, you went too far already. The chart on the right is consumers chiming in. This is from the Consumer Confidence Survey. This is a survey where they call and say, hey, how do you feel about things now? And until recently, people have been saying, things are okay now. Well, how do you feel about things in the future? And until recently, they'd been saying, well, it's okay. But now they're saying, oh, things in the future look really, really bad. When you get a divergence that's that big in those two answers, that blue line that goes down, it's consumers saying, I'm really way more concerned about the future. And every time it goes down, it's followed by recession as well. Now, I've given you lots of reasons why I think there's a slowdown. Let me make sure I'm not saying we're getting into a recession, rather a slowdown. And a lot of economists had been saying that, but it hasn't started yet. People are saying, you've been telling us about this for a while. Why hasn't it started? I've been telling you about it because we saw inflation in the Federal Reserve a couple of years ago moving, and that's a fundamental. And here's some reasons why it hasn't happened. First, we'll go back to that chart that shows that lag. It takes time for changes in monetary policy to have full effect, and all those interest rate increases haven't had that chance. The chart in the middle is a measure of the Fed funds rate after inflation, and it has to get high enough to choke off the economy, and you can see those red circles followed by the recession. And currently, we haven't quite gotten there fast enough. And another measure on the right compares the Fed funds rate to how fast the economy is growing, and that's got to get to zero to slow the economy down, and that's not quite there yet. So there's a couple of reasons. Here's some other reasons. The blue line is net interest payments that corporations are paying. You see, when interest rates were zero, corporations took on a fair amount of very low level debt, and so are paying very low interest payments. The other line there is the Fed funds rate. So it's like the corporations are saying, go ahead, Fed, raise interest rates all you want. We locked in a while ago. Same chart is on the right, only it's consumers. The light blue line is the debt service ratio. It's just a percentage of your income that you have to pay for mortgage and consumer debt. And you can see it's quite low. It basically means consumers took on debt at a very low level. So it's the same sort of situation there. Now, so that's a couple of the reasons why. Now, what's next? Well, the chart on the left we saw earlier is personal consumption expenditures, but now they're facing the headwind there on the right. That's a survey showing people when student loan repayments kick in, which is already in October, what they're going to sacrifice in terms of spending. So the survey says 36% of the respondents there, that blue column, are going to cut down dining and so forth and so on. And what else is coming for the future? It's all about consumers. The chart on the left shows personal income. We saw that earlier, very weak. So if you don't have income to power spending, where do you turn? Well, you could go to savings. That's the chart on the right. Savings are going down. So if you don't have income and you don't have savings, where do you go? Well, to credit cards, naturally. That's the chart on the left. That's the amount of credit card debt outstanding. It's up 32% in 2 years. That's pretty steep. And it's rising at a rate there in the middle. Those are interest rates at an outrageous rate of 21% on average. And of course, if your credit's not so good, it's an even higher rate. And so you have debt getting taken on at high interest rates, and that results on the chart on the left, which is credit card delinquencies, and that's up sharply. Finally, I'll show you the chart that I talked about earlier and that the other gentleman talked about in the video. This is the Fed always raises until something breaks. That's the chart there on the left, the Fed funds rate, and you can see it raised here over on the left until it broke the savings and loan crisis, and then the tequila crisis, and so forth. The chart in the middle is the same thing over the past 100 years. The Fed always raises too far until something breaks. The chart on the right is us. It has broken the number of bankruptcies. Number of bankruptcies filing is up. It says 30%. It's actually almost 40% year over year now. And we expect it to be 50%, which is a disastrous increase But again, it's off a low base. And by the way, you can see those blue columns, the number of insolvencies filed. It's continuously increased over the past 4 decades. There's only one other variable I could think of that has increased continuously over the past 4 years, 4 decades. That's that dark line. That's long-term interest rate, the 10-year interest rate. And you can see all the way over on the right how it's backed up because the Federal Reserve has been raising interest rates. And as a result, bankruptcy filings have already gone up sharply, and we expect them to continue to go up sharply. So that's what's breaking for us. Let me wrap up here and talk, this is what we've been talking about. The economy does have some signs of strength. We have some budget problems, inflation killing purchasing power, hurting the housing, manufacturing, freight, labor markets weakening, consumer outlook is poor. And it's really because the Fed started so late on its path of interest rate hikes to control inflation. They started so far behind. They've had to be so aggressive, and it's damaged the economy. And we believe that the economy will be skating around a recession in 2024. Let us say that it's going to be a significant downturn. So that is our outlook at the moment. I know it's not the happiest thing, but that's what it is. That's what we see coming forward. And I thank you very, very much for your attention and for having me today. And at this point, I'm going to turn it back over to Nancy.
Great. Thank you, Dan. You just did a really great job of boiling down very complex issues into really understandable bites. And I appreciate it. My background's in economics. And so one of the reasons that I just love talking about these things, they obviously impact all of us, and being able to distill it into really understandable ways is fantastic. So, I mean, you kind of shook your head about the Fed waiting too long, about you just not understanding why they did. I mean, any thoughts about why the Fed took so long? You think?
Yeah, well, there are a couple things. One, they were very, very sure that the inflation was a result of supply chain problems, which may have contributed, and a result of labor shortages, which may have contributed. But really what it was this. Central banks like to have a little cushion of inflation. 2% is kind of the target. And they like to have that so that if they need to, they can cut rates a little bit. And it also keeps them away from zero or negative inflation when monetary policy becomes impotent. So 2% is the target. And over the past couple of decades, they couldn't get to 2%. So they said, we're going to change policy. It used to be that when we saw inflation coming, we'd raise rates to fend off inflation. Now we're not going to do that. If we see inflation coming, we're not going to raise rates. We're going to leave it there. And we're going to let inflation grow to 2% and higher and let it stay there. That's the new policy they came up with a couple of years ago. It's called inflation targeting. And so that's what they did. That's why they waited so long. But since they waited that long and inflation roared ahead that much, we can see that policy probably backfired on them. But they just can't change horses in the middle of the creek. They can't say, whoops, our idea doesn't work right now, so let's go back to the old way of doing it. It kind of ruins credibility.
Right. So I'm going to ask you the $10 million question that all of us who are invested in the stock market want to know. What's your view on what the stock market is going to do next year? And just a quick reminder, please post your questions in the chat so that we can get your answers from Dan.
Yeah, so you're asking what the stock market's going to do, and the answer is, I don't know. And anybody that tells you they know are probably trying to fool you and fooling themselves. I worked in investment research for 3 years, and one of the things I learned was that you can't time the market. It's very difficult to tell what the market's going to do over the next month or even the next year. And there's several studies that are very compelling that looked at the S&P 500 over a 20-year period, And it turns out over that period, the biggest return come in a handful of days over 20 years. So if you miss the best 10 days in 20 years, your return gets cut in half over that, cut in half. So you'd have to be pretty clever to be in and out, or in those best 10 days and out the rest of the time. If you try that, you're going to lose. You will make the mistake, the classic investor mistake of selling at the bottom and selling at the top and buying at the bottom. You'll lose. And the other thing is you really can't pick stocks. Some money managers might be able to do it, but by and large, over time, most money managers who have so many more resources and tools don't beat their benchmarks. So you really need to go into index investing. It's the most clever, best way of going about it. But next month, next year, I don't know.
Gotcha. All right, I have a question that came in, and I don't know if you saw this yet. So earlier this morning, the Chicago Purchasing Managers Index, the PMI number for November was released. For those of you who don't know, it's a measure of economic health in the manufacturing sector. The Chicago PMI for November was the best report relative to expectations, 55.8 versus 46 since September 2020, and the fifth best versus expectations since 1998. I know it's just one indicator at one moment in time, but do you think that this is any indication for a soft landing? I know you had a number of negatives in there as well, but and it's 12 points higher than the October reading. Your thoughts?
Right. So there obviously in any economic time series, there's variation. This sounds like a pretty big boost to me. So it's certainly something to look at, but it's important to note this is just for the Chicago area. And we do look at it, but it's only applies to that area of the country. And I'd like to look at more areas and basically nationwide as well.
Sure.
But I would say that is a surprise anytime things are significantly above expectations. That's a surprise. It sounds like a good surprise if you're in manufacturing. But I think all the other stuff I've been looking at, durable goods orders, industrial production, and the other PMI, which is the one I showed from not S&P, but from the ISM, kind of still argues for recession in manufacturing.
Okay. This administration, the previous administration, and also because of COVID, there has been a lot of talk about deglobalization, right? So sort of onshoring, so to speak, and changing up your supply chains. What do you think the effect of sort of this deglobalization will have on the economy?
Well, it's going to take time. It's pretty hard to just rebuild a supply chain in the matter of a year
Absolutely.
or two. So it's going to take time. But the big effect of globalization, let me put it this way, was deflation, really. Over the past couple of decades, there's all this argument that a lot of jobs went to China and Mexico and so forth. And that's true to a certain extent. But the flip side is consumers got a tremendous benefit. Consumers, 70% of the economy, were able to get tremendous amounts of goods that were produced by people at wages that were a tiny fraction of ours. And so goods and services came to us at a very, very low price. So you would argue the other way around, that if we're bringing more and more onshore into an environment where there are higher wages, then that would contribute to more inflationary effects. That would be one effect. I do think it's probably wise. We've seen now how vulnerable that we are to, this magnificent global supply chain, but there are downsides as well. We have been exposed to to China, where we're finding out that suddenly we need a lot of goods from China that maybe, if they wanted to, wouldn't flow our way. So it's I think is good to reverse what was probably went too far, and it may result in higher inflation, but I think it's probably a good economic policy.
Interesting. Okay, here is a question. What are the chances that the Fed will continue to increase rates in 2024?
I think they're pretty slim. Because we have seen, for the most part, for most measures, inflation is coming down. And again, I think they realize that they've already shot a lot of those interest rate increases at the economy, at inflation, that haven't taken a hold yet, but will. So we see inflation coming down, and pressures on inflation are going to continue to come down as well. So I think that they're probably going to be on hold. Certainly the financial markets, the Fed funds futures market, which is a pretty good indicator, says, December, there's no way that they're going to hike in December.
Mm-hmm.
And in fact, they're looking at cuts in the middle of the next year. I think that's a little optimistic, but I think the possibility of raising rates again is pretty small.
Mm-hmm. But you think that the chance of cuts are also slim?
I think there'll be cuts in 2024, but not until later in the year. Financial markets, the Fed funds futures market is saying, hey, May or June, we're going to start seeing cuts. I have a hard time buying that.
Right. Do we have a question, another question, I think, coming through? Okay, in the meantime, what will the rise in consumer credit debt, and you talked about this, have on the economy going forward?
Right. Well, there are a couple different effects here. One is consumer credit's getting harder to get. And so is industrial and corporate debt. It's getting harder to get. So there's less credit available, and typically that is a pretty big weight on the economy. So that is certainly one effect. The other thing to think about is, for consumers, they actually started off in a pretty good position. The balance sheet was fairly clean. So I don't think that that's going to, let's see, the level of debt is going to be particularly harmful, but rather the increase in debt, if they can get it.
Mm-hmm.
Consumer debt, in the big picture, yeah, we certainly would like to pare that down. I think the federal debt is a bigger problem, especially since politically there isn't a solution.
Right.
But I will go off for a second saying that's, reducing the debt, reducing the deficit isn't splitting the atom. This is a matter of, if you think of entitlement programs as, water coming in, that's tax revenue going into the program, and benefits coming out of the bottom. Well, all you have to do is increase the inflow and decrease the outflow. Well, how do you do that? Well, you could increase taxes a little bit. You could slow down the benefits in a number of different ways. It's not, it's mathematically pretty easily, but one important way to do this is, those could help some, but what would really help would be to embrace skilled legal immigration, because we know skilled immigrants create more jobs here. They add more value. They pay into those Social Security and Medicare systems, creating more benefits there. That would be a really good solution, a long-term solution. And this is what Canada does to a much greater extent. So it can be fixed. You see that debt to GDP ratio of over 100% in 30 years, or way over 100%. Already, Japan, for instance, has a debt to GDP ratio that's twice as big as ours, but their growth rate is 0. And that's the trade-off. You can sustain high debt levels indefinitely, especially if you're the world's largest economy and the reserve currency. You can do that indefinitely, but your growth rate gets traded down to zero. So it's certainly not desirable. It's not a disaster, and it can be fixed.
Well, you're talking about, I think, 3 different areas that are definitely very politically difficult, right? So taxes, increasing taxes, hard political issue, immigration, hard political issue, and decreasing discretionary spending, or even some of the mandatory spending is obviously all 3 very difficult political issues
Right.
in a time that we have difficulty passing what sometimes feels like the simplest
That's right.
of things just to have the government function. So I certainly hear what you're saying, but definitely hard thing. So, okay, I think we're going to put up another question now. So will the demographic shift of baby boomers from putting money into stocks via their 401k pension funds to drawing down those assets to fund retirement put pressure on the markets?
I have heard this theory before, and let me just say it out loud again. So baby boomers have acquired this 401k wealth. Now to fund their retirement, they're going to be selling it. Well, yeah, that's I suppose is a possibility. But there are always buyers and sellers. And the question is, if you have assets in your 401k, stocks, for instance, stocks companies are basically continuously growing and adding value. So because somebody is selling them, somebody else is going to be buying them. And in the meantime, corporations are going to continue to add value over the longer time period. So I've heard this concern before, and it's something to think about for sure. But that's kind of one of the more doomsday-ish scenario, and I think there's too much militating against it.
Got it. Okay, one final question as we sort of wrap up the discussion. What do you think the future of the U.S. dollar is?
Oh, I think the U.S. dollar is going to be fine for decades. It's still pretty much the reserve currency in the whole world. It's the majority of foreign exchange activity, real activity, is denominated in dollars. There's Chinese yuan and yen and British pounds and euros as well, but dollar is still the currency of choice. I've been asked that question for a couple decades as well. Mm-hmm. People are concerned about it, but we're still the largest economy, and a few years ago it was obvious that China was going to be by far the biggest economy soon, and that seems to not be the case anymore. So I have less concern about the dollar than other issues.
Okay, great. Well, listen, Dan, wrapping up the hour here. Thank you so much. I think this discussion was extremely informative. For those who have joined us today, thank you for spending some time with us this morning. We'll be sending out the video, and if you want copies of Dan's slides, which economists always say are good the moment that they are released and dated, because things obviously change. But thank you so much, Dan. And I wish everybody a very happy holiday and a wonderful new year. And we'll see you all next year. Thanks, okay. Dan. Take care. Bye-bye.
Thanks, Nancy. Bye-bye.